Hello, it's Robert Miner with Dynamic Traders Group for their DT trade strategies for the week beginning January 18th. These are 5 and 10 minute videos we do each week for our Twitter, YouTube followers to give you a little taste of what we do in our DT reports every day and week after week, where we have much more expanded videos. But we take a look at one or two markets. That's what we're going to do today. Alert you to potential trade strategies, as well as hopefully teach you a bit about practical trade strategies, fib analysis, Elliott wave analysis, dual time frame momentum, and that sort of thing. If you want to learn more, check out my book, High Probability Trading Strategies, or our DT reports. Okay, let's get started. First, we're going to look at the VXX. That's an ETF that represents a volatility in the S&P and the stock indexes. And it's a very interesting ETF. It has some very significant moves and percentage change moves, at least. Even some of these short pops. This is the weekly data, by the way. These 1 and 2 week advances are sometimes 20, 30, and 40%. So fairly substantial. And of course, also with the potential of significant gain is you got to be aware of position sizing, so you place where your stop is so you don't overtrade and risk more than your trading plan. And as we teach, is you should never risk more than about 3% of your account on any one trade. So you kind of back in the position size depending on where you enter, where the stop is, etc. So that said, we look at this now and then. I did a trade in this a week or two ago. Got stopped out because there wasn't any follow through. But we're now again in an even more interesting position. So I'm going to lay this out for you. You can decide whether it's something for you or not. So this is the weekly data of the VXX. And we can look at, I've circled and highlighted these last several weeks. And that notice that's just been flat. What's the stock index has been doing since the early December, the stock indexes? Well, they've consistently continued to advance. And typically, if the stock indexes are advancing, the VXX declines. They move just opposite of each other. If the VXX makes a low, it makes a low when the stocks make a top. And usually the stocks then have a fairly fast move to the downside over a week or two. Doesn't necessarily be that long a time period. And the VXX, of course, does just the opposite. So given that the VXX is flat over the last several weeks, stocks have been consistently, the stock indexes have been pretty consistently advancing over that time. That's a wake-up call. That's a divergence. And it means that there's a lot of money going into the VXX. So we're going to assume, or hopefully anyway, it's fairly smart money that's going into the VXX to hedge against a potential decline in the stock indexes. So that divergence to me is a wake-up call to consider a trade in the VXX. Here's what else happened this past week that's significant, is that number one, even though this is a very narrow week, it made a slight new low, it's what's called, in this case, a foreclose bull reversal. Why do we call it foreclosed bull reversal, weekly foreclosed bull reversal? Well, it's because last week closed above the weekly closes of the past 4 weeks. Now, that's another wake-up call. That means there's some buying that came in to the market, and as of the end of the week, the buying was sustained because we closed above the closes of the past 4 weeks, and we closed near the high of the week. Now, that itself isn't an all-out go bull situation, but all of those are wake-up calls. Plus, last week, the 8 DT oscillator made a bull reversal on a price momentum bullish divergence. So the 13 was already bullish, the 5 was already bullish, and the 8 is fairly significant. It made a bull reversal, and it's pretty reliable. That indicates the market's going to be sideways up for at least 2 or 3 weeks. And the bullish divergence, momentum price bullish divergence, is that price was flat, but the momentum low was at a higher low than the last low. So that's a bullish divergence. So all of those say, let's take a look at the VXX and devise a strategy to take advantage if it takes off. So here's the daily data. And on the daily data is Friday had a pretty good up day, and it made a bull reversal in the momentum again on a momentum price bull divergence, and that the momentum was higher and we had made a lower low in the price. So again, that's a wake-up call to say, let's consider a specific trade strategy. So the specific trade strategy that I usually use is once the two time frames, at least two time frames, are in sync with each other, indicating a continuation, in this case, of a bull trend, is that typically I'll look for a close above the prior minor closing swing high. So I'm just going to hit closes on here. So if we close above 1734, that's a specific entry setup. So I use the same sort of process on every time frame in almost every market. So you might consider this if we get some kind of breakout on the upside, that would be a specific setup to go long with a stop no further than below this low. Now keep in mind, percentage-wise, that's a ways away. So just use your position sizing so you don't risk any more capital than your trade plan allows you to risk. So that's a setup in the VXX. Let's take a look at one more market that we've been looking at fairly consistently, at least on and off, over the past several weeks. So this is the Euro weekly data. We've looked at the Euro on and off for the last few weeks, and you can look at the videos of the last 3 weeks where I describe how we were near the end of a wave, or probably at least near the end of a wave 5 of 5 in price and in time, and it's almost textbook pattern coming up from the March low from an Elliott wave perspective. So we indeed 2 weeks ago made that top, and this past week was down strongly as anticipated. Anticipated why? We reached time, price, pattern, dual time frame momentum for a weekly high. Then we made our weekly momentum bear reversal, and then we made on the daily, at least, we made then the reversal confirmation signal this past week, and then we ended up being down throughout the week. So that's after the fact analysis. What about now? Well, what's significant now is we've probably made a top that's going to last at least several weeks, if not several months. So we're going to have to orient our trading if we want to trade on the short side, not on the long side. So more than likely, we're going to make a correction to the advance from the March low, and that should last several weeks, if not months. And the minimum time target for a corrective decline would be after mid-March. Now that's after mid-March. So that's basically another 2 months. Now we usually trade weekly trends, and there can be 2 or 3 cycles of weekly trends between now and mid-March, but it looks fairly bearish for quite a while. So that's information that you can use to make specific trade decisions. This is the daily data, and the date shows the data coming up from the November wave 4 low, and boy, this is textbook Elliott wave. It doesn't happen that clean that often. We're potentially near what we call a daily low. That's a low that's going to last a few days. The daily momentums are dual look back oversold, and we have potentially a 5-wave decline here, and we're potentially in that last section of what we call 5-wave decline. That just means we'd be making a low probably in the next 2 to 3 trading days, a low that would then reverse to bullish for 3 or 4 or 5 days, something like that, for a correction. And the reason I want to bring that up is that's going to be the next really great opportunity, because the weekly momentums are bearish. If we get the next cycle in the daily momentums where we get that 3 to 5 day corrective advance and then a bear reversal in the daily momentum, that'll put the daily and weekly momentum in sync to continue the bear trend, and it'll be a real high probability, low capital exposure setup. So once again, as I teach over and over and over again, we're not forecasting the future. We're trading, not forecasting. We're identifying conditions with a high probability outcome that we can take advantage of. So that's where we're at with the euro. And one more, let's real quickly here, look at the 240-minute data again. After this correction was made earlier in this past week, then we look at if this is a 1, 2, 3, 4. Notice my language, if it is. And if this is a wave 4 high, then the ideal target for a wave 5 was 127, 162% external retracement. So that gives us a probable minimum target on the downside. And of course, we reached that as of Friday. Now, that doesn't mean the decline is over. It does mean that we've reached in a position to complete this decline, but we may still have another day or so net bear trend. But anytime we get like a reversal day, or a bull reversal in daily momentum, we've probably completed that low, and we're in a position to do that. Okay, Robert Miner, appreciate you coming by. I'm over and out for now. Be safe. I'll be back with you next week. Take care.